The balance of trade stands as a barometer of the country's economic health and its relationship with the global market. It represents the net differences between the country's total export and import. This calculation proves two conditions with the trade surplus and trade deficit. Trade surplus indicates a positive balance of trade in which country export exceeds its import value. Meanwhile, trade deficit is the exact opposite, which occurs when a country import exceeds export value. Economists often analyze the balance of trade because it influences the currency strength, employment, industrial competitiveness, and overall macroeconomic stability.
2.0 Comparison of Malaysia major export and import. Malaysia is an open economy where gross domestic product (GDP) growth is much dependent on the international trade. Malaysia trade surplus has been positive going for the last 10 years, from 2015 to 2024. This is to say, the country has never imported more in goods than it has exported, or more crudely put, it always earned money selling its goods abroad. In 2015, for instance, there was a trade surplus of RM91.5 billion, and this figure rose significantly after the pandemic until it hit over RM250 billion in 2022, before steadying at an estimate RM130 to RM150 billion in 2024. Such a process is facilitated by the export of a variety of manufactured goods and commodities in demand on the world market. Electronic and electrical (E&E) is a major traded product of Malaysia. The product also continued to be the leading export item between 2015 to 2024, which an increased value from about RM277.9 billion during 2015 to RM575 billion in 2023. Meanwhile, Malaysia also import a large number of E&E components which estimate value between RM200 billion and 480 billion annually. This is attributed to Malaysia's widespread as the assembly hub for the world where raw materials are imported, processed and re-exported in the form of final goods. This industry has always generated very high surplus, which indicates that Malaysia enjoys a competitive advantage in the area of high-tech manufacturing. The second largest category of petroleum is refined oil, crude oil and liquefied natural gas (LNG). The total amount of value of LNG and petroleum export combined in 2015 was approximately RM19 billion to 100 billion. By 2022 until 2024, the same export will soar above RM200 billion annually in higher world energy prices. Import-wise, its import refined petroleum products start from RM40 billion to RM125 billion a year in order to cater for the nation's industry and transportation needs. Despite being a net importer of petroleum, the fact that Malaysia is one of the world's most significant natural gas exporters means it actually adds positively to its trade balance, particularly with trading partners like Japan and China.
Palm oil is also still the country's main agricultural commodity, supporting balance of trade. In 2015, we touched 63 billion ringgit for palm-based products and then skyrocketed to hit a record high of 135 billion ringgit in the year 2022. Before stabilizing at about 19 billion ringgit to 100 billion ringgit marked by 2023 and 2024. Unlike electrical and electronic products and petroleum-related trade, Malaysia's import value for palm-based products is negligible, typically below 10 billion ringgit. This indicates that palm oil export contributes strongly as a net positive to Malaysia's trade surplus. Overall, this highlights how Malaysia's natural resources-based commodities, particularly palm oil, can help stabilize external trade performance even during periods of volatility in global manufacturing markets. Overall, during the period 2015 until 2024, Malaysia recorded a sustainable trade surplus, indicating that export values consistently exceed imports. Malaysia's major exports were largely dominated by electrical and electronics products, refined petroleum, as well as palm oil and palm-based products, which serve as significant contributors to national income and international trade. At the same time, Malaysia's import mainly comprise raw materials, industrial components, and machinery and equipment. reflecting the manufacturing sector's reliance on external input to sustain productivity. Although imports volumes increased due to industrial demand, the stability of key exports reinforced Malaysia's position as a competitive and relevant economy at the global level.
I will present an analysis of Japan's trade balance, focusing on three major product categories, which are mineral fuels and oil, electrical and electronic equipment, and basic food products. Overall, Japan's trade balance shows a strong reliance on imports for essential resources while maintaining competitiveness in selected export-oriented industries. Among these sectors, mineral fuels and oil play the most significant role in shaping Japan's trade performance. Japan is one of the world's largest importers of mineral fuels because it produces almost no crude oil domestically. Between 2017 and 2019, imports of fossil fuels such as crude oil, liquefied natural gas, and coal remain consistently high, averaging around 150 to 160 billion USD per year. Energy imports accounted for the largest share of Japan's total import value during this period. In 2020, global energy demand declined due to the COVID-19 pandemic, causing Japan's fuel import value to temporarily fall to about 140 billion USD. However, this reduction was short-lived. From 2001 to 2022, global economic recovery and sharp increases in energy prices, especially following the Russia-Ukraine conflict, caused Japan fuel imports to rise significantly, reaching approximately 118 billion USD in 2021 and 200 billion USD in 2022. This surge contributed to Japan recording its largest annual trade deficit in 2022. Although global energy prices eased slightly after 2023, mineral fuels remain Japan's largest import category, with imports reaching around 168.7 billion USD in 2024. Since Japan exports very little in this sector, mineral fuels continue to create a substantial and persistent trade deficit.
Moving on to the electrical and electronic equipment sector, this industry includes integrated circuits, electronic components, computers, and advanced machinery. It is one of Japan's most important export-oriented sectors. Between 2017 and 2019, Japan exported approximately 95 to 100 billion US dollar worth of electrical machinery annually, while importing around 90 to 95 billion US dollar. This reflects Japan's strong position in high-value manufacturing, alongside its reliance on global supply chains for specialized components. In 2020, the COVID-19 pandemic disrupted production and logistics, causing exports and imports in the sector to decline by about 5 to 7%. However, from 2021 to 2022, rising global demand for semiconductors boosted exports to roughly 105 billion US dollar, while imports also increased. By 2023 and 2024, trade in this sector became relatively balanced, with exports at about 101 billion US dollar and imports at 106 billion US dollar, resulting in a small trade deficit. This highlights Japan's dual role as both a leading electronics producer and a major importer of intermediate goods. Lastly, basic food products also significantly influence Japan's trade balance. Due to limited agricultural land and production capacity, Japan depends heavily on food imports. From 2017 to 2019, food imports averaged 70 to 75 billion US dollar annually, while exports were much lower at around 7 to 8 billion US dollar. By 2024, food export reached a record 9.7 billion US dollar, supported by strong global demand for Japanese processed foods and seafood. However, imports remain high at approximately 78 to 80 billion US dollar, keeping the food sector in a persistent trade deficit. In conclusion, Japan's trade balance is largely shaped by its heavy reliance on imported energy and food, while exports in electronics and processed food help reduce but not eliminate the overall deficit. As a result, Japan's trade performance remains highly sensitive to global energy prices and external economic conditions.
Malaysia's export structure is mostly centered on raw materials such as palm oil, crude petroleum and rubber. Japan, however, focuses on exporting finished products that rely heavily on advanced technology. For examples, cars, electronics and industrial machine. This is because these goods require high skill and innovation. Japanese products usually carry higher prices in international market. In macroeconomic terms, countries that export high-value products tend to gain more stable income from a trade. A trade surplus happens when export earning higher than imports payment. This situation increases demand for the country's currency, strengthens its exchange rate, and supports overall economic growth. Meanwhile, a trade deficit occurs when imports exceed export. When this happens, a country needs to send more money abroad, which can be put pressure on its currency and weaken economic performance if the deficit continues for a long period.
This relationship highlights the fundamental connection between Malaysia's and Japan's trade performance and key macroeconomic indicators such as economic growth, exchange rates, and inflation. According to Bank Negara Malaysia, export of coal continued to expand while growth in capital and intermediate import moderate, indicating a strengthening external factor contributing to economic growth. As foreign demand for Malaysia and Japanese coal increases, aggregate demand AD rises, leading to higher national output and GDP growth. The GDP growth pattern of Malaysia and Japan from 2015 to 2024 are closely linked to their respective trade balance performance. Malaysia's relatively strong GDP growth between 2015 to 2019 was supported by a positive trade balance driven by exports of electrical and electronic products, commodities and manufactured goods, which contribute significantly to overall economic expansion. In contrast, Japan's slower growth during the same period reflects a more subdued trade performance, where export growth was constrained by weak global demand and structural challenges, thus limiting its contribution to GDP growth. In 2020, both Malaysia and Japan experienced sharp economic contraction as the COVID-19 pandemic disrupted global supply chains and international trade flows. Malaysia's GDP declined by 5.5%, largely due to reduced export demand and falling commodity prices, which weakened its trade surplus. On the other hand, Japan's economy contracted by 4.2%, reflecting declining exports of automobiles and industrial goods amid global lockdowns. During the post-pandemic recovery, Malaysia experienced a strong rebound in economic growth, particularly in 2022. This recovery was closely linked to the surge in export and improvement in the trade balance as the global demand recovered. Although growth moderated in 2023-2024, sustained export activity continued to support positive GDP growth. In contrast, Japan's economic recovery remained modest. Rising import costs, weaker export growth, and a slower improvement in trade balance limited the contribution of net trade to GDP. As a result, Japan's economic expansion has been more subdued compared to Malaysia's export-led recovery. Other than that, positive GDP growth also influenced the currency movement. In Malaysia, stronger export and higher foreign exchange inflows helped the support of Malaysian ringgit, reducing import costs and strengthening the investor confidence. Japan, however, presents a more complex picture. Despite higher interest rates, the Japanese yen remained weak due to interest rate differentials, energy costs, and the broader market dynamics. While a weaker yen boosts export competitiveness, it also raises import costs, limiting the overall economic gains. Ultimately, the enduring truth is that the trade balance serves as a definitive economic scorecard. The simple measure of export versus import is not just an accounting ledger. It's a powerful indicator of a country's true underlying economic strength and its global competitiveness.
Overall, Malaysia recorded a higher trade surplus than Japan, with the availability of key resources such as LNG and palm oil, rubber and electricity and electronics. Malaysia's economic activities are growing rapidly in line with the development of the modern era. This is said to be because high demand from other countries is pushing the Malaysian sector to produce more goods and export goods abroad, which is completely dependent on Malaysia's main trade resources in developing their economy. Similarly, Japan, which has high-tech goods where machinery, vehicle and industrial equipment are exported abroad, can help Japan's economic growth more rapidly. With the availability of key resources from these two countries, namely Japan and Malaysia, it will clearly be able to help supply goods to the economies of other countries to meet the needs of the world market.